start recording this also. Yeah, okay, so this recording will be in your Teams chat log as well, and then I'm also uploading it to your uh, course website under lecture videos. All right, so this will go in as number 2 today once I finish the recording and we finish the class. Okay, so what does it say? Your recording, yours. Yeah, okay. All right, so the second point on the agenda is this. Now, this project versus ideal sequence. Okay, this is sequence. Now, what is the point I'm trying to make here? Now, one of the things you'll notice as we go through this course, okay, and it is your duty to inform me whenever you have any kind of problem accessing the notes, or if you read some note and you don't understand what we are saying there. Okay, like we have one where I've not yet prepared the video, functions of financial markets. If you're reading something and you don't understand this price discovery, I didn't understand what this stuff is, it's your responsibility to ask me the question, okay? Otherwise, I will not be able to figure out who's got a problem where, because there are too many students. So you have to be proactive, and any problem you have, if you feel this is not properly written, that's why these are kept as dynamic notes. So I didn't understand this price discovery. Okay, then based on your input, I may add a few more lines. Okay, so I may write it a little better, like I may try to explain it a little better. So it is your responsibility to keep on giving me feedback about what you don't understand, so I can explain it or I can improve the notes. All right, so you have to be proactive about that. Okay, now what would happen typically is, we'll take this out. Okay, so what would happen typically, ideally, is that we would first go through, this is the sequence of topics you see over here. This is actually how we should normally introduce these topics. Okay, these are not topics you would find it generally in any finance textbook, because they are usually written by academics, and this is my own perspective based on my market experience, and this is what I think that people should learn when they have to transact in financial markets. And pretty much every finance role requires that. So this is a different kind of content, but this is how I would ideally teach it. This is the sequence, okay? But unfortunately, we do not have the luxury of time, because we have to finish this project and we have only 2 months. And so therefore, what I would do is, first I would go through the entire sequence, because this is the logical flow of topics. I would finish everything, and then I would start on the project. But unfortunately, we can't operate in the ideal world. Okay, so the project driven sequence versus the ideal sequence. So we can't follow the ideal sequence. That's why you see I'm jumping straight away into the project brief. Okay, the project brief is because we have to do this project. So I have to give you some specific skills which are required just to do the project, which is why the other day we had this. We discussed all these kinds of issues, because I have to get you guys quickly into the project mode, so that you can actually have some basic skills to do your project in a sensible way, right? Now, even after I give you a project brief, you may still find that I'm not able to figure out what's going on, and I'm feeling like I'm just being thrown in the water. I have not been taught how to swim. Okay, and that is going to happen. Okay, the idea here is that you will be looking at all these, you'll have to track all these markets, right? And you will be quite lost, because you have not done this before, and I have not had the time to really teach you everything. So we'll be learning as, so basically I'm going to throw you in the water, and then while you're struggling in the water, I will be teaching you how to swim. All right, so it's going to feel like that this is not, so if it feels like that, don't be surprised, it is natural. And this is one of the problems we have, because we don't have time. Okay, as I said, we have an ideal sequence, but we don't have the luxury of following the ideal sequence. So please understand this. When you're going to feel like I don't have the skill set to do this project, that's okay. You will learn as you go. All right, this is meant to be a learning process. So you should feel free to make mistakes and just do your project sincerely. All right, so let's let's get into the actual project brief. Continue with the actual project brief. So let me just, this you'll notice that in your folder, okay, in your folder here under students, now you have all these things. You have the notes, and then I put in a separate folder called project. All right, there's this spreadsheet over here which I've opened over here. All right, the IPM 20. Now what is this? This is, remember in the last meeting we had discussed that I would give you a bunch of tickers. All right, the universe of stocks that you're going to trade. So these are your tickers. Mainly what you're concerned is with the one in the top set, okay, not the bottom set, the top set. This part, the bottom set, I'll explain what that is. All right, now how did we so this is basically what you're going to be trading, which means I wanted to give you some kind of structure so that you look at all these if you look at if you look at markets, if you look at stocks, if you look at most active stocks, okay, you have 203 results here. Okay, now the question is, it can be a little confusing, which stocks should I choose, right? So in order to help you to give you some structure, I have given you a set of stocks, and one of the things we have, so it can become very confusing because there are thousands of stocks that are listed. So I will just I have given you a set of stocks, right, which is the universe, from which means now in this project you can only trade these stocks. Let me put this in some kind of special highlight. I'll explain what that other one is. Which color should I use? All right. Okay, so this here you have this stuff in green. These are the tickers, so which means you cannot go outside this list. So some of your big favorite companies like Google, Amazon, etc., or Facebook are out of this list. They are not in this list. There is a reason for that, and that their stocks are quite high priced, and we'll come to that discussion of why I've left out the stocks, those stocks. And so what we'll get into first is the discussion on how I arrived at this list, okay, and that will give you some kind of idea. Sorry, before that, okay, yeah, Vipul's question we have already answered. So, okay, so let's get into this question of how did we arrive at this set of stocks. All right, so let's look at this problem initially. So let's look at the project brief. Okay, now we are going to do the project brief. Sort of a discussion on the project brief. Okay, so right, so you are given a certain amount of money. Okay, you are given a certain amount of money, are given to you, a certain amount of money is given to you by an investor. All right, okay, right. Now, so the first question you have, we are going to move a little bit. Actually, what we are covering today, as I said, this is not going to be in sequence because we don't have the luxury of going in sequence. What we are actually covering is over here, okay? So perhaps you could read this note later on after the class. I'll give you a very quick rundown, okay? So what we are covering is basically this part, the asset classes, markets, and instrument at this point of time. So this discussion right now, okay. So when you're given a set of investable funds, and the other thing I'm going to do today, okay. So one of the things you have to do is, now you're given this money by an investor and you're told, okay, invest this money for me, all right. So what are some of the questions that go through your mind? How do you think about investing this money? Let's ask somebody, let's ask Sambhavna. What will you do if somebody gives you, let's say in this case, 1 million? Okay, this is how we write million from the foreign exchange markets jargon. Okay, in the foreign exchange markets we write million as MIO, MIO. Okay, so Sambhavna, can you tell us what would your thinking be like if you're given investable funds of 1 million by an investor and he doesn't give you any kind of sort of constraint? He says, okay, go and invest this money for me. Now where will you go? Where will you go and put this money? How will you think about where to put it?
Can I invest in any kind of assets?
Okay, 1 minute. Let's do one thing now. Let me just, as she's making her comments, in the notes master, Oh no, I put it in the IPM calc file. Okay, in the calc file, I have created this. This is going to be your spreadsheet equivalent of this file. Okay, so here we use this as our running notes from day to day, and here we're going to use it like a board. Okay, you guys are already noticing some of the other teachers are using whiteboards and stuff like that. Now I am going to be using this spreadsheet and this note as a whiteboard essentially. Okay, this is where we are writing down stuff, so you can access it later on. The way this is going to be structured, this is going to be in your calc file, which you can launch from here. Okay, this is your calc file. In the calc file there will be a session calc spreadsheet. So this is here. Okay, so here's where we are going to start putting up her answers. Okay, maybe put up this point here. All right, so we have this discussion about investable funds. Okay, so what is somebody Sambhavna saying is she's going to put it in some asset. Which asset?
Um, the real estate, mutual funds.
Okay, real estate and mutual funds. Okay, 1 minute. Assets, she's talking about real estate. Okay, mutual funds. All right, okay. Let's ask Saloni. What else? You have any other ideas you want to add to what Sambhavna is saying?
Hello.
Yes.
Yes, sir.
Yeah, Saloni, yes. What happened? We can't hear her. What? You have an audio problem or you have a thinking problem?
Sir, I can think.
Okay,
Right.
thinking. Okay, while she's thinking, okay, let's ask Jakar. Jakar, you have still not responded with your ID and password, by the way. What happened to Jakar? He's not present.
Sorry, it's not on the call.
Okay, he's not on the call. Okay, all right. Okay. We have a lot of people with their hands raised, so I should ask all these people. Okay, all right. Let's ask Harsh. Yes, Harsh. What is your point?
Sir, if I have $1 million,
Yeah.
sir, in that case, first I will invest in government saving schemes that are provided by the post office.
So
I
you're
will
talking
invest.
about, okay. So you're talking
Yes,
about safe assets.
yes, sir.
Okay. All right.
Safe assets first.
Okay.
Sir, first I'll invest in these bonds and debentures that are issued by government companies.
Okay. So
And
safe assets essentially that means generally when we talk about safe assets, what do we talk about in finance? We're talking about what we call
sir,
sovereign
fixed
debt,
return.
government
Sir,
debt. Okay.
we, yes, sir, government debt.
Okay. All right. Okay. Then anything else?
Mm, Sir, I'll buy shares of some company, those who are doing good.
Okay. Some shares. So these
Sir,
shares are essentially equities. Okay.
yeah, equity shares, yes, sir.
All right. Okay. So, all right. Okay. Let's go through some of the other people who had raised their hands. Rag. Yes, Rag.
Yes, sir.
Yes.
Sir, I will also invest in the equity market, but like first, I will invest some of the amount in large cap stocks, and some I will keep for regular trading, intraday trading, and some amount I will keep for like if there is an IPO or something, I will keep some amount reserved for that, so that
Okay.
I can invest in that when the time comes.
Large cap, IPO. Okay, intraday. Okay, fine. These are all terms that we are using. Good. We have to clarify these terms. These are actually not mutually exclusive. Some of the terms that you are using, so we have to be careful about that. Okay, so we'll ask now. What we'll do is we will, instead of asking so many people, I'll come to you guys. Keep your hands raised. Utsav, Aman, then Vipul and Sachin. Just unless you have a specific question which is confusing to you, if you just want to answer this question, I'll come to you for in the future. Okay, just keep your. I think if I what happens is if I can actually move this to this side, and then I can monitor you guys here without having to interrupt the screen display. All right, let's hope this thing works because I've got two screens, so I can. There's one screen on which I keep the windows which I'm experimenting with, and the other screen where I show you whatever we are discussing as our display. All right. So we've written down some stuff. Now I'll just quickly, because I need to cut down the time as well. We can't spend too much time on one question. The first thing that you have to think about, now these things are all, as I said, these are all discussed in this part of the note number section 5 actually, which is asset classes. You'll get some perspective from reading that. Okay. So we asked this question about investable funds, and we got this kind of a few answers from your batchmates. Right now, the way we think about it, ideally, I'll just give you a quick rundown, then later on we'll go through this in greater detail when we get into the decision problems. But right now my goal is to quickly set you up for the project. Okay, so the way you have to think about this, if you notice some of the things that we said, now Sambhava mentioned real estate. Now she mentioned mutual funds, which is actually, you can also have mutual funds that focus on real estate. So therefore these are not mutually exclusive. All right. So now here large cap IPOs intraday, okay, these are also not strictly speaking mutually exclusive, because you can do intraday trading in large cap stocks, right? So therefore these are not mutually exclusive. So one of the things you guys have to remember as you're learning, okay, is when you're doing when you're learning general principles of learning, that you have to always talk in terms of mutually exclusive categories. There is also a, you remember we had this session on taxonomy in lab, you guys remember that?
Yes, sir.
Yes,
Yeah,
sir.
yeah. So
Yes,
Yeah.
sir.
yeah. So always, so just to give you an example, I mean, not to criticize, when I'm giving you inputs, I'm not criticizing what students are saying. I'm just trying to show you how you you can improve your thinking. So I'll just take the example that, I mean, so two examples, is Sambhavna's example and Rag's example. Both of them have given categories which are not mutually exclusive, because you can do large cap trading in intraday you can do intraday trading in large cap stocks. You can also
So
have
can I
IPOs.
clarify one thing?
Yes.
So what I meant by large cap was large cap for long term investments and mid cap and small cap for intraday.
Okay, fine. In that case, fine. You're clarifying it. Okay, I understand what you're saying. Okay. So anyway, the lesson is, I still want to hammer home the lesson that you have to always talk in terms of mutually exclusive categories. Okay. So that you should remember always, because actually this is a common mistake that you'll find even people in industry make. A lot of people make this mistake, but this forces you to think in a highly structured manner. All right. So always remember this: the principles of taxonomy that I taught you in lab, that your category, one of those principles, that your categories, whenever you give a set of categories, they must be mutually exclusive. All right. So let's just look at one of these frameworks, which you will find in your notes when you go to the asset classes section. So the right way to think about it, actually, when you are given this amount of money first, investable funds, the right way to think about it is that you have to think about in terms of asset classes. All right. If you have asset classes, I'll just try to bring up asset classes. So we'll go through this in detail later on. I'll just try to run through it quickly today, so that we don't lose too much time, right? The way you think about it, I'm just giving you a quick rundown, and then we'll come to, let's look at futures here. Right. Now, asset classes essentially is a category of markets. We'll have to reduce this a little bit, right? So the way we do asset classes is there are basically 5 major asset classes, which I have defined here, okay, in this framework. You will be able to launch this framework from your notes. Okay, so in this framework, we have talked about 5 major asset classes. Asset class essentially is just a set of markets which are going to be moving together in general. All right. So if you have currencies, then when you're looking at currency markets, they tend to move in, generally they tend to be influenced in the same way by the same factors, and they move a little differently from the commodity markets, from the equity markets, from the debt markets. So historically these were the 4 major asset classes: currencies, commodities, equities, and debt. But now we have, since the financial crisis of 2007-8, we have a other important emerging asset class, which is real estate, because it started behaving differently from the other asset classes. So we can talk about 5 major asset classes. These are the major asset classes. So the way we think about it when we get some money to invest is, the first question you have to ask yourself is, which asset class are we going to invest in? Okay, let me put this in. It's a diagram, right? So I'm just going to give you the which asset class are we going to invest in? Right. So if you talk about asset, see, when you look at a bunch of markets, okay, if you can see here in this, I don't know if you guys can read. Can you read this stuff? Like this is cocoa without my highlighting. Can you read next to cocoa is cotton, then there's orange juice. Are you able to read the notes? I mean, are you able to read the names?
Yes, sir.
Okay, good. Okay. So, yeah, so this, when you see a bunch of markets like this, it's very difficult to kind of make sense of them. So one of the things you do is you do a taxonomy. Okay, now this is a taxonomy of markets, asset classes. That's why this is called taxonomy and perspective. So you group them into asset classes. Okay, so you have currencies, commodities, equities, etc. So for instance, when you look at this, so where will natural gas go? Which asset class will natural gas be in?
Commodities.
Commodity.
Commodities, sir.
Correct,
Commodity.
excellent, excellent. So natural gas will go into commodities, okay? Then if you are looking at the NASDAQ 100, where will that go? Here, NASDAQ 100, we
Stock.
discussed. Yes?
Equities.
Equities, correct? Equities. So Nasdaq 100, I taught you last time that this is the major tech index. Okay, we discussed. I showed you how the Nasdaq 100 is already at new highs. All right, for after the coronavirus, because so many tech stocks, the ticker for the Nasdaq 100 is if we just look at say 5 years, you can see it's all-time highs. Okay, this is the coronavirus, this is the COVID-19 sell-off, and this is already at all-time highs. All right. So okay, everybody has to mute. Somebody is not on mute. Who is not on mute? Okay, it is okay. I think it was Rag who was not on mute. Maybe I'm not sure. Okay. All right. So yeah, no, it's just that when I scroll through. Okay. All right. So this is Nasdaq. So this is the Nasdaq is going to be going into equities. So this is how you look at markets. When you look at a whole bunch of markets, you feel a little confused. And one of the benefits of having a taxonomy is that it helps you to group markets together into group markets into categories, and then that gives you some better sense of perspective. All right. So for instance, if you go into currency, if you go into say euro or yen, okay, or sterling, these would go into which asset class here?
Currency.
They would go into
Currency.
currencies. Okay, so you can straight away see the value of having a taxonomy and this kind of a framework, that it helps you to make sense of when you're looking at so many markets. You can make a little bit more, you can get a little bit more clarity by grouping it into asset classes. So the first decision that you have to take is, when you're given some money and the investor doesn't give you any constraints, says you do whatever you want, just invest this money for me. So you have to take a decision about which asset class am I going to go into. Is this point clear to everyone? Have you understood this point? I'm going to introduce this term. We are already doing the decision problems. I'm going to introduce this term, although we are going to handle it in more details later. Everybody understands what a decision problem is? Yes? Everybody? I think I gave you this example. If you're going to have lunch and you can only have one dish, now whether you want to have masala dosa or you want to have pizza or you want to have a roll or something, this is a decision problem, because if you have the dosa, then you can't have the pizza, right? So you need to make a decision, and let's say you have only a limited amount of money. So if you put it into some kind of, it's a resource allocation problem, and these are usually mutual, we can define it as a all right. So a decision problem is a, uh, let's say, define it to need to choose a decision there is a problem of scarce or limited resources, very much like what you learned in economics. Okay, you might be familiar. So you have scarce or limited resources, you need to choose a decision. Scarce or limited, allocate to mutually exclusive users. Okay, so in the lunch example that I gave you, you have a limited amount of money, you have limited tiffin money for lunch, and then you have to either use it to buy pizza, or you use it to buy dosa, or you use it to buy a roll or lasagna or whatever. But if you buy the lasagna, then you can't have the pizza, right? So this is what I mean by mutually exclusive, and you have limited resources, so you need to, now you have a problem, which one should I choose? Is everyone clear now what a decision problem is? Okay, we've just come up with a formal definition of a decision problem, but we are going to be dealing, and this is what we are handling right now. We are handling the decision problem. When the when so just a little note, guys, because we have a lot of material to cover. Okay, you may notice that in the finance course, I may not be as like I gave you some opportunity to ask questions earlier, to give inputs earlier. Okay, which we noted down here. But I may not be asking you that many questions, and it may be a little bit more like a lecture tutorial kind of a style of teaching, because this is because we have a lot of material to cover. Okay, so we are treating you like adults. You are all here to learn, because companies will not hire you unless you've learned something. So it is your responsibility, but I will always answer questions. This is a golden rule that I always follow, that any question, like you remember last time Vipul and others were asking a lot of questions, and I answered all the questions. So I never decline a question. At the most, I might postpone it to another session. So this is not always the case. Okay, even in IIM Ahmedabad, we had some professors who would not answer student questions. They would just say, okay, we'll do it later, and then it would never get addressed. But they wanted to teach what they had come prepared to teach. So this is a particular this is also a style of part of the style of teaching. So in my philosophy of teaching, the student questions are always the most important. That's why you're here in class. So any question you ask, I will answer it. So therefore, it is your responsibility as adult learners to anytime you have any doubt, like you'll notice Vipul asks a lot of questions, which is very good. So anytime you have any doubt, you should ask a question. You have some thought, I want to add some point here, you can ask a question. Okay, now Sachin has his hand up. We'll check with Sachin. Sachin, yes, anything you want to say?
Yes, sir. Sir, you just given us some stocks. These all stocks are stocks, or some stocks are just like some stocks. For example, some stocks are crude or something else. Yeah, all these are stocks, normal investing stocks.
No,
This
this stuff that can you guys see the coloring here? Can you see that this stuff is in green background? Can you see that? Is the color coming through? Yes, Sachin, can you see
yes,
the
no, sir.
colors?
Green color, yes, sir.
Yeah, you can see green, right? Okay, good. Because
Yes,
sometimes in the projector in the class, we would have a problem with the color. Like I would
yes,
be seeing green and you would see blue and all this stuff.
no, no.
Okay. So anyway, so the short answer to Sachin's question, actually I'm coming to the answer, but the short answer to Sachin's question is they are all equities.
There are all
They
yes,
are,
sir.
yeah, they are all equities, because this is a particular equity trading project. But I was trying to come to this question in a, as you notice, my answers are always, everywhere my answers are very long. Okay, you ask a short question, I give you long answers. That's because I want to make sure that you understand the entire context of the answer, because this is not physics. Finance is not physics, where the
Yes,
answers
sir.
can be very precise. But here you have to understand the entire context, so that's why I give you long answers. So short answer to Sachin's question was that whether these are all equities, or some of these are commodities, or some are currencies. No,
Yes,
answer
sir.
is no. All of these are equities. Okay, these are all
Yes, sir.
individual stocks, common stocks of individual companies. These are all the tickers. You're talking about 33 tickers, total 33 tickers. So I
Yes,
was
sir.
going to explain how I came here. That's why I started with the basic question and the basic decision problem of asset class. Okay, all
Yes, sir.
right. Okay, does that answer your question, Sachin?
Yes, sir. Yes, sir.
Okay,
Exactly.
okay. And also on questions, prayer, remember, for my teaching philosophy, answering student questions is the number one priority. So, and when, for instance, I have answered Sachin's question, now if he is not happy with the answer, he should ask. He should ask, I didn't understand this part, but or he should say that, no, actually, what I was asking is something else. Like, for instance, when I gave input on Rag's points, then Rag clarified that what I meant was that large cap is for long-term investment, and mid cap, small cap is for intraday. Now you should do that. Okay, that's what it is all about. So basically, the whole thing. So answering student questions are a priority. So you have to make use of that benefit. As I told you, even in IIM Ahmedabad, we did not get that facility from quite a few of the professors. So make use of the facility that I'm giving you by answering all student questions. Okay. So, but at the same time, I will tend to be in a lecture mode so that I can cover more material. Because otherwise, if I go through the whole class asking, okay, Ava, tell me what you think, Aman, tell me what you think, Bhavya, tell me what you think, then we will be just listening to inputs on one question for the whole session. Okay, so that's. I hope you guys understand what I'm talking about here. I'm talking about why I'm trying to do it in lecture form so I can cover more material. Okay, is that clear? All
Yes,
right.
sir.
Okay, good. All right. Okay. So where were we? Okay, here we were here. So the first decision you have to take when the investor gives you this money. The reason I'm saying 1 million is this 1 million is actually the money that you have in the IBTWS paper trading account. Okay, they're not giving you 100 million. They're giving you only 1 million. Okay. What happened? There's some echo coming from somewhere. I don't know where. Okay. All right. So the first decision is which asset class do I invest this money in? Okay. Currencies, commodities, equities, debt, real estate. These are all asset classes. All right. So I mean, as far as that decision problem is concerned, we have chosen equities. Okay, for this project we have chosen equities. So I want to lead you to this set of markets by showing you how the formal decision problems are being solved. So the most fundamental question is which asset class should I invest in? You can invest in more than one also. There's no you don't have to necessarily be confined to one asset class. Okay, there are certain styles of trading in the alternative asset management universe, like in hedge funds. You have certain styles called global macro, where they trade in currencies, they trade in equity, big indices, they trade in debt, they trade in commodities. So you don't have to. The point I'm trying to answer to clarify here is when you're making this decision when you're solving this decision problem about asset class, you don't have to. We can perhaps make it ES. You can also decide which asset classes, not just one asset class. It's in this particular project we have chosen one asset class, but you can in general choose anything you want, any number of asset classes, right? Okay. The second decision that you have to take is when you look at okay, now let's say we have chosen equities, right? So we'll come to this instrument part later. Let's say we have chosen equities, so we have gone into this row, all right? And when we look at the universe of equities, let's look at this site was also giving me problems earlier. Okay, so let's look at this. When I look at equities, I go to Yahoo Finance, I see the most active stocks. All right. So just looking at the most active stocks. Now you see a problem here. Let's look at the heat map view and see what it's like. Or we can look at the heat map here. Let's look at the maps here. This display is called a heat map. Okay, have you heard this term before? We are discussing this term, so let's talk about this. All types of jargon and technical terms which we discuss, we are going to make sure we make a note of it so that you are alerted to the fact that, okay, this is a technical term that we have discussed, we should know what it is, all right? So let me just say here. Yeah, okay, I'm going to put this link in your notes so that this is a heat map. All right, this is called a heat map. Why is it called a heat map? Because it's trying to show it's trying to give you a visual picture of which stocks have gone up, which stocks have gone down. All right, so you can see the code over here. I don't know if you can see it here, but if you notice here, can you see this -3%? This is based on a period, okay, which is 1 day performance. So -3% means there will be deep red. Little bit less red means -2%, and little bit less red, even less red is -1%. And similarly, then here you have +3%, +2%, and so the green. You understand the idea, right? Very bright green. Okay, 1 minute. I'm going into mute. Okay. All right. I'm back. I'll just ignore the background noise. All right. So this is what we want to understand as a heat map. So this is very, very, very bright. Means if you look at this Costco, which is I think one of your stocks. Okay. Costco is very bright green. So this is a big discount store in the U.S. Very big discount store. Okay. So this Costco is up at least 3%, more than 3%. So you can see it's in bright green. Okay. The other stuff, which is like Amazon, is less than 1%. So therefore, it is deep green. This is what a heat map is. Okay. So everybody gets the idea about the heat map. Is this clear to everyone? It's a visual way of displaying your overall stock market information. Everyone clear about the heat map? Yes, guys. Akshita, are you clear?
Distribution.
Yes. Somebody has a question. Sambhavna has a question. Who has a question?
Sir, Vipul.
Sorry, I
Hello?
Yes, yes.
Sir, Vipul this side.
Yeah, Vipul, tell me, what is the question?
Sir, this is sectorial distribution.
Sir, what distribution?
Sir, different sectors like
Yes, yes. So they have mentioned the sectors as well, but the idea is that if your question is that the heat map need not, you can also have a heat map by sector, okay? But this is actually not a heat map by sector. This is a heat map by individual stock, all right? It is showing you the individual stocks. So it's a heat map like Apple is an individual stock, okay? It is Microsoft is an individual stock. Verizon is this Visa actually. The Verizon is VZ. Visa is an individual stock. I understand why Vipul asked this question about sectoral distribution, because he's looking at, when I put up Visa, it says financial credit services. So these are sectors. Like Apple, it says technology, consumer electronics. These are sectors, industry sectors. So that's why he asked the question. Am I right, Vipul? That's why you asked, right?
yes, sir.
Yeah. So, but the answer to your question is no. This is not a sectoral distribution heat map, but the sectoral information is provided as an addendum when we highlight the stocks. But this is actually a stock-based heat map, individual stock-based. All right. So the point of showing this heat map was, what was my point? I was coming to the second decision problem. Now I have already decided that I'm going into equities as far as asset class is concerned. But when I go to this group, to the heat map, and I see all these stocks, look at the number of stocks. I see so many stocks, all right? So I get confused. I mean, look at these number of stocks. Look, when I go to the most actives, or let me just, this heat map view is not very, let's look at the listing view, that is better. I look at the most active stocks and I see, oh my God, there are 203 stocks. Which one should I buy? Or which one should I even follow? Forget about buy or sell. Which one should I follow? So it's very confusing. So the second decision that I have to take is, let's call this DP. One. DP is for decision problem, okay? Now we actually are discussing the heat map in the context of DP2. So the second decision problem is which markets, all right? Now, Unfortunately, I have not had time to go through your discussion of markets also. This is the problem that we have because we have so little time. Actually, we are supposed to go through a discussion of markets, but hopefully you guys have read some of the notes. If you see the notes, we have defined markets as, okay, under financial market functions of financial markets, we have okay, defined financial market. You have to go through these notes on your own later on. Okay, make sure you go through the introductory notes. Okay, these introductory notes are, you can always follow the sequence, but we have to skip through quickly. I mean, it's not that you don't need to know this, but it will take you time to go, it will take me time to go through these topics. But if you go through all these topics in the right sequence, then it comes to the asset classes. But you may have to read this earlier a little bit because of the way that we are doing the project related information. Okay, once again, if you have any confusion, I am not able to follow this, I didn't follow why this goes after this or this comes before this, it is your responsibility to ask me with any confusion. As I told you, I don't put any restriction on questions. I put a high priority on answering student questions, so you should have no compunctions about asking questions. Should not have any hesitation that I will not like this question or anything like that. Any question can be asked, so it is your responsibility. You have any confusion, you must ask me. Okay, otherwise I will not know that you have a problem, and then I will clarify. Okay, so the markets, we are coming to the second question is, which markets have I've decided equity, but when I go to equities and I start looking at this, I get very, oh my god, look at the number of stocks, there's so many stocks, which one should I follow? Okay, here also I see 203 stocks. I'm very confused now, which one should I choose? Okay, which stock should I even follow, right? So these are all markets. Okay, individually these are all markets, and I'll come to the definition. That if you read your introductory notes, you'll find that we have defined financial markets as venues to exchange assets. All right, and essentially a market is a, this is not the right note to pick up actually. We have defined it in the first note itself. The definitions of markets, I'm launching the first note. So we need to quickly recap our definition of markets. Yeah. Okay. So let's look at the second definition first. This is the second. The second definition is, a market is a venue for exchanging two assets for one another. It's a very technical definition. So a market is a venue for exchanging two assets for one another. Okay, a venue for exchanging assets. And then we further refined this into the third definition, which is the working definition. Is a market is a venue, physical, virtual, for exchanging money for some type of asset. Okay, so remember this definition. Don't memorize it, but just try to understand it. Okay, understand the logic. So there's a logical sequence to these notes. Everything is logical. So please try to understand things from a logical point of view. And if you have any questions, you must ask me. But do not memorize. Okay, memorizing will not help you in life. So you must understand it conceptually. Understand the logic. So we are looking at financial markets. Essentially, you'll be looking at all financial markets will be a value for exchanging some asset for money. Okay, there will be money on one side, and there will be some type of asset on one side. Okay, so here if we take this definition here and apply it here, you will see that these are all markets. You see this Microsoft. Okay, this price of Microsoft 213. What is this 213? What does this mean? One common stock of Microsoft is worth 213 what? Indian rupees. Okay, yes, Rajat. Let's ask Rajat, RJ, radio jockey. What is this?
Yes, sir.
213 is what? Indian rupees?
There are single price for a single share.
No, no, single price, yeah, but what? It is Indian rupees. 213 Indian rupees.
Yes, sir, we are operating in US market, na? So it is in dollars.
Okay, correct. So now Rajat has given us the definition, has given us the application of the definition to this particular market. Now understand this, this is a market. This is a market for Microsoft common stock. Why is it a market? match it with our definition. Okay, definitely on the one side we have one asset which is common stock of Microsoft. On the other side, as Rajat has clarified, the other side is US dollars, right? You are exchanging Microsoft common stock for US dollars. Okay, this is the first, our recap of our first concept of markets. Is everyone clear about this? This is a market for the common stock of Microsoft. What are the two assets? Because it's a market, this must be a venue for exchanging assets, and generally we will have asset on one side, some type of asset on one side and money on the other side. Here what you have is Microsoft common stock and US dollars on the other side. Is this clear to everybody? Yes? Everyone is clear?
Yes, sir.
Okay, good, excellent. So this is how we are going to
Yes, sir.
understand markets, and now this is why I say that when I look at this heat map of the S&P 500 stocks, look at the number of stocks I see here. There are 500 stocks. I'm very confused. Okay, which one should I follow? I can't follow 500 stocks. So this is where we need to do a further fine tuning, because remember, we are going through the problems that we gave initially to Sambhavna, that the investor has given her $1 million. Now she has to, he didn't put any constraints. Now she has to put some constraints on herself, otherwise she will go crazy. Because if you look at all these asset classes, just in equities, just in US equities, S&P 500 is US listed equities. Now imagine if I bring in, oh, I tell her that's, oh, what about Japanese equities? She goes to meet her friends, and then some of them tell her, no, why don't you invest in Japanese equities? And some of them tell her, no, you invest in UK equities. Then some other person will tell her, go and invest in German equity. Then she'll become totally confused, because there's so many markets to choose from. How are you going to filter? So the first filter that we have already applied to you is essentially, under equities we have applied markets. Okay, under markets we have already started choosing. So we have chosen US equities. Okay, but we still have problems, because if we choose S&P 500, we still have problems. Okay, US equities, we still see too many stocks. Now we have to further cut this down. So now we come back to Vipul's question when he was talking about sectoral distribution. Okay, now how do we further fine tune this? This brings you to the question of, how did I come up with these stocks? This Sachin was asking us whether these are actually all equities. These are all equities, yes, but how did I come up with this stuff, and what does all this mean, this BMCS, etc.? Okay, so this is how you do it when you are an equity investor. Okay, when you have decided to become an equity investor, you have to also choose which US equities, Indian equities, UK equities will be GB. Okay, if you notice, British websites, if you go to British websites, it will be .gb, because of GBP is the currency symbol. So Indian equities will be .in. Then you can go to German websites, they will be .de, because the Deutschmark symbol was DE. All right. So this was another problem that you had, that okay, we are not listing it as a separate decision problem, but within DP2 you have a separate problem when you're looking at equities or even other asset classes. You have to now start looking at which countries' markets. Okay, US markets, Indian markets, UK markets, German markets. All right. Okay, so you have this problem also, but we have chosen US. Okay, so I will put this stuff in smaller type, and I'll make it not bold. All right. So I've chosen. Is everyone clear about this? I've just shown us that I've just shown you here that you have to also decide which countries' equities to look at, and you could look at various countries. We can put dot 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 here. Dot 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 means you can go on and on like this, but we have chosen US equity. But even within US equities, we have this problem: too many stocks. Now we come to the sectoral distribution. Okay. Now we come to the sectoral distribution. How did I come up with this? Now here what we do is go in this, under this, let's put this link also in your notes. All right. This is what I'm looking at now. Okay, so if you go under FinViz, you go to groups. Okay, Under groups you will find this. Under groups there are various tabs, okay. Under groups you have to choose the overview tab, okay. This shows you the major. Are you guys able to read the are you able to read? Let's ask double A. Can you read this? Number 6 is financial. Can you read this? Is the font big enough?
Yes, sir.
Okay,
Yes,
great.
sir.
Yes, sir.
Okay, great. Excellent. So you will see now this is the sectoral classification of US equities. All right, the sectoral classification. Now, so let's mention this term, sectoral classification. Now, since the US is such an important market, okay, it's a very important point. I want to make this once here, that a lot of times, especially in the Indian business school programs, they teach finance from an Indian perspective. Now, that is, playing tennis, being a professional tennis player, and not playing in the Grand Slams. So India is a backwater of global finance because our policies are very socialistic. So this is not the right way to study finance. For marketing, we study from an Indian perspective, but not finance. So finance has to be studied from a US perspective, which is the biggest market in the world, most liquid markets. So it is your responsibility as a finance student to know what's going on in the US financial markets. So therefore, you should be familiar with this basic classification in the US markets. But in general, we need to get this idea of sectoral classification. This is a general principle, okay? So this is a particular sectoral classification for the US markets. Now, if you were to look at Indian equities, let's say somebody wants to later on become, Ava wants to become an equity analyst, okay? Then she's sitting on the equity desk at IIFL, let's say, and then she's looking at classification of Indian equities. Then she may not see the exact same sectors. But the idea is that she will still remember the general principle, which is that I need to do a sectoral classification, okay? And sectoral and also industry, okay? You have industry and then you have sector, okay? There's some difference in the uh, how you define sector and industry, but the idea is both these terms are used, okay. You have this. So the idea is that she will have to remember that you have to do some kind. I have to do some kind of sectoral and industry classification. So she will look at all the Indian equities and then she'll do a sectoral and industry classification. And the particular sectors that she comes up with may be different from the ones over here in the US. There maybe she will come up with 8 sectors, not 11. Okay, but that's not so important. What is more important is the general principle is that when you're looking at the equities of any particular country or even the debt securities, you will have to do a sectoral and industry classification. Are you guys following what I'm saying here? Bhavya, are you following what I'm saying here? General principles?
Yes, sir.
Okay, good. So understand, because your learning has to be always in terms of general principles. Okay, you will have some specific learning also, but the general principles are more important. What you're learning here is that when I look at the equities of any country, if you're going to Japanese equities, I must do a sectoral and industry classification. That's what it is, okay? So this, when you see these terms here, BM, CS, CC, etc., this is basically nothing but BM is basic materials, CC is I don't know why, CS is communication services, and consumer cyclical is CC. Okay, this is what it is. So these are your sectors, and these are the individual equities within the sector. All right. So now this is basically the process. Okay, so this is why I have come up with these categories, and then I have stocks under these. But I didn't want to give you too many stocks. So 33 is a good enough universe to track. So your eyes are going to be only on this universe in your IPM trading project. All right. So now further, how did I select these individual equities? Because if you look at BM, let's just look at BM. I gave you only 3 stocks from BM. How did I come up with 3 stocks? Because if you do your own research, yes, any question? Okay, I thought somebody had a question. Okay. All right. So if you click on BM, let's click on BM. We have 234 stocks. See, 234 stocks in BM, Alcoa, all these things. Okay, all these companies. Now, how did I come up with only 3 stocks out of 234 in BM? Okay, so let's look at how I came up with that, because I have given you only 3 stocks. But when you click on BM, you see that there are 234 stocks. So how did I come up with 3 stocks? So this is how we'll understand this, how I came up with this the short list of 3 stocks. Okay, before we do that, I will just go through one more problem here, which is we'll just briefly classify one more problem, which is a third problem, DP3. All right, DP3 is can you guys Gagan, can you tell me, if you look at this framework that I'm showing you now, I discussed 2 decision problems. We discussed first problem is which asset class, second problem is which markets. And if you look at this this framework here, what do you think the third decision problem is? Can you guess, Gagan? Okay, never mind. Let's ask Gaurav. Gaurav?
Yes, sir.
Yeah, you want to guess? Is my question clear? I am
Yes,
asking
sir.
you to guess the third decision problem in sequence that we should be discussing. By looking at this framework, I'm giving you a hint already. I said that you have to choose the asset class. Then when you go into equities as your asset class of choice, then you get very confused and you have to therefore take a decision on which individual markets to choose. That's why I came up with these individual markets under the sectoral classification. I've only given you 3 markets to look at for each sector. All right. But before we come to how I came up with those 3 markets, I'm asking you, is there any other question? Is there any other decision problem that we can think of at the initial stage that we have to choose?
Sir, I think which particular asset to choose or how much to invest.
Okay, that will also be a decision problem. Okay, but let me give you a link. Let me give you a hint here that you see here when you're looking
Sir,
at.
may I?
Yes, yes. Yes,
Sir,
Utsav.
instruments,
Utsav,
type
you
of
want to,
instruments.
yeah. I will come to Aman later. Let's. Okay, what is Utsav saying?
Sir, the third problem, decision problem would be type of instrument to invest in. Is cash, spot, future, forward, or swap.
Correct, correct. Okay, so Utsav has got it correct. Yeah, what was Aman saying?
Sir, sector or industry?
So which one? Sector or industry? Okay. All right. So that, yeah, that was a, yeah, that is also a question to decide. Okay. But I was actually asking about this one, which is the one that Utsav had answered, because I was pointing you to that the clue lies in the
Okay.
fact that I was pointing you to that framework. Okay.
Thank you, sir.
Instruments, again, instruments, because you could choose only one instrument or you could choose many instruments. Okay, so if you look at this, if you look at, say, for instance, so where are we here? Okay, so if you look at, if you are going to be a currency, if you're managing a currency fund, you could be investing in cash, but cash is not very actively traded. But spot is a very actively traded instrument. Currency spot, biggest market in the world actually, just for your information. 500 I think 513 or something like that, some huge amount of $1 trillion a day. Okay, so sorry, not 500, 5 trillion dollars, like 5.3 or 5.6 trillion dollars a day for the last survey that we had. So 5.6 trillion dollars a day. This is actually the biggest market in the world, the spot market for currencies. All right, now these are different types of instruments, and instruments, if you see a sequence of notes, we are talking about this is discussed over here. Yeah, so you'll get some idea from contracts itself when you have transactions as contracts to exchange assets. I'll give you a brief idea at this point, which is that essentially what is an instrument. Again, as we will tackle all these in greater detail later on. Those who have some remaining questions, you can always ask me, or you can even clarify your own doubts by going ahead and reading through the notes, because all the notes are ready. Okay, so you can read the notes and but generally I just give you an idea. You're already familiar with contracts from your contract law sessions, right? So contract, remember, a contract will have certain contract terms. Okay, so in this says contract terms, and those are negotiated between the parties. So essentially the spot What is the difference between spot, futures, forwards, swaps, options? These are, just think of these as different types of contracts. Okay, these are just different types of contracts. So therefore, since they are different types of contracts, they have different types of features. I mean, they have different types of terms. Okay, if you have a contract for employment, okay, if you are hiring somebody at DSB, then he has a different type of contract terms. He has to come to office every day. He gets a fixed salary every month. But if we hire somebody to maybe do something for us where he gets a sales commission for something, then he may not have a basic salary. He may have only a sales commission, so he doesn't get paid unless he manages to sell something, right? So those are different types of contracts. So the terms are also different. So you can think of instruments. Remember, these are instruments, okay? So when you think of these, when you might hear these terms, and when you hear these terms, you have to think of them as instruments. And these are, instrument means these are just different types of contracts. A spot contract is different from this, from this, from this, this. These are all different types of contracts. Okay. So the point that Utsav has made is correct, that the third major decision problem that we have is which type of instrument to choose. All right. Now in this project, as I said, we are not handling this whole framework in detail right now. We are only handling, I'm trying to just quickly go through the decision problems superficially, so that you have an understanding of how you came to this
Sir,
decision. Yeah. Yes.
sir, you have put futures and options as a different instrument,
Yes.
but they come on one derivative uh,
No, no, no.
derivatives. Future and options comes under derivative market, sir. So, sir, why you have put it different, futures and options?
No, in the sense that, see, let's put it this way. Let's say you are a PGDM student. Now, you might have a buddy who is actually doing BA LLB in VIPs. Okay. Now, both of you will come under this. This is like the VIP students. You are, let's say, like a futures contract, and your buddy who is doing BBA LLB, BA LLB is a options, under options, and you are under futures because this is PGDM. And then your buddy doing BA LLB is like being under options. But both of you are falling under derivative markets because both of you are VIPs, I mean on the VIPs campus. If I say VIP students, I mean people who are on the VIPs campus. Then Vipul is a PGDM student and his buddy is a BA LLB student. But they are both under the same category of VIP students. So does that answer your question, Vipul?
Yes, sir.
Okay. So I want to understand, when you said futures and options are falling under derivatives, are you your question is driven by this classification on my framework here, or is it driven by the normal classification, the normal discussions we have in India about FNO segment, derivatives and all, futures and options? Are you being influenced by that discussion? The FNO segment discussion in the on local TV and all that. Is that why you were asking? Yes, Vipul?
Sir, you are actually, sir, I am not listening you properly, sir. Can you repeat?
Okay, never mind. It's not so important. But you have understood my answer to your question, right?
Yes, sir. Because sir, I think they are the same thing. Because there is equal amount of risk involved in both the future and option.
Yeah. So this is
That's
how
right.
you remember the example I gave you, right? Both
Yeah, yes, sir. Yes, sir.
both BALLB
DSP
and
and
PGDM are both they are slightly different because they are studying different subjects, but they are also same in the sense that they are both VIP students. So similarly, futures, forwards, swaps, and options, they are all different types of instruments, but there is a common feature in that they are all derivative markets. Is this clear to everyone? This is how you read the framework, okay? We will explain this
okay, sir.
framework.
Okay.
Yeah, we explain it little in detail later on. But this is how you're supposed to read the framework. Okay. So as Utsav has clarified, the third decision problem we have to decide is, because if we decide to do equities, so we decided to invest in equities, but that doesn't solve our problem because we still have to decide what equity options, equity spot, or equity futures, forward swaps, which one. So in that, for our project, we have chosen spot. Okay. And generally this is the most popular instrument for trading equities. The most popular instruments for trading equities, most popular is spot. This I'm talking about global standards. Most popular is spot, and after that is options. Okay, in some countries like India, we have equity futures also quite actively traded, but most popular in generally, if you look at global trends, spot is the most popular, and the next second most popular is options. Okay, I just gave example of FB options, means this is an example of a market. Facebook options, right? So if you choose any company, if you choose Ford Motor here, if you choose the stocks of Ford Motor here, you choose, if you go to Yahoo Finance, you will see one of the options, one of the alternatives given to you under Ford Motor Company is you can look at the options of Ford Motor Company. So this 686 is the spot price. Okay, this is the spot price for one common stock of Ford Motor. So in this market for Ford Motor common stock, we call this, remember the language, okay? Remember the structure of the language. This is a market for Ford Motor Company common stock. The two assets in this market are common stock of Ford Motor Company and NYSE, so therefore US dollars, okay? So therefore the other asset is US dollars. So this is one stock, one common share of Ford Motor Company. You can buy it for 6.86 US dollars. Okay, just recapping the definition of markets, very important to understand it clearly because we're going to be using it all the time. Now you see this is the spot price, but there are also many options. If I choose an option very much later, further out, okay, let's choose September 18th option, and then I can see that there are options trading. If you see, if we choose the straddle view in options, so in your third project, in, I don't know whether it's going to be second or third FDRM project, that will be on option trading, that will be on trading equity options. In this project you are trading on spot. In this project, in the IPM project, you are trading spot instruments on US equities. When you go to your FDRM project, you will be trading options on US equities. Okay, and then I will not let you trade the spot. You will have to trade only options. Okay, here you cannot trade anything else, you have to trade only the spot. So the important thing to understand here is that the learning here is that these are all instruments. You may hear these terms being thrown around. Okay, sometimes you'll see people saying equities, debt, futures and options. You'll see sometimes there are actually books where they have this kind of classification. This is not correct actually, because these are equities and debt are asset classes, and futures and options are instruments. So you should not be mixing the two. All right, it's like saying, you know, Germans, Japanese, doctors and engineers. So some of the doctors will be German, some of the doctors will be Japanese. So you can't have a classification like that. Okay, so understand that this is not correct classification. So make sure you understand that point. Okay, so the third decision is instruments. Okay, how did we come to the instruments? So what instruments are we going to trade? Okay, everyone following so far? Yes. Let's ask Kanika. Kanika, are you
Yes,
following?
sir.
Okay. All right. Okay. Okay. So third decision that we have to take is instruments, and I have chosen the instrument for you. It is spot. Okay. Now again, as I said, it could be instruments. In this case, I have given you only one instrument type. You can also decide that I will trade spot and options. That is your choice. But it's a decision that has to be made. Right. Now coming back to the question that Sachin was asking, which is how did those are equities, and then of course then I further added to that question, how did we come up with that classification? How did I come up with these three stocks only in the case of the communication services or basic materials? Okay, so here we have some considerations of now these three basic decisions. Okay, DP1, DP2 and DP3. Let me reduce the uh, I think you can still read if we have the three DPs, and I will reduce the space in between so you can see everything in one. Okay, I'll just leave it here. I'll put the heat map as a Google Docs is very good when it comes to all these things. You know, their handling of hyperlinks and all is really good. It's much better than OneDrive. So anyway, okay. So DP 1, 2, and 3. Now normally when we decide these things, there's a consider. How do we decide? How do I take these kind of decisions? There are usually considerations of expertise. Okay. So if you go back to this initial question, now Sambhavna and Rag and others who had answered that question. Okay. Where I think Harsh also answered that question. They may think about their expertise. Now they may decide that, let's say they are a team, they may decide that, okay, we don't know much about commodities, we don't know much about currencies, but we understand equity markets very well. So that's one of the reasons they might have chosen equities. All right. So this is decided by questions of competence, but there are also a question of DP1 to DP3. Okay. The kind of considerations that lead us to the decisions, one is expertise, and the other is liquidity is a major consideration. Okay, we want to be talking about liquidity and free very liquid stocks. Everybody understands what liquidity is? Okay, I'll just try to quickly explain today because I want to make sure I show you the stock screener. Liquidity basically means just actively traded stocks. Okay, liquidity means ability to transact large volumes in a market. Spelling mistakes may be there. Without significantly impacting the price. Okay, right. Now you understand that whenever you deal in a market, you can impact the price if your trading volume is very large. Okay, let's say there are very few empty houses available for sale in Pitampura, and some big shot investor comes in from abroad and wants to say, I want to buy 20 houses in Pitampura. Maybe there are only 21 houses available. So obviously this will have an impact on the price if you have a large bulk order for that kind of quantity, which is so disproportionately large. Right, it will start moving the prices up. Is everyone clear about that? Okay, you understand? So the idea is, if you have a very liquid market, the idea is that essentially you can transact large volumes in a market without there should be high liquidity, low liquidity, or a high or good liquidity. Way I've given the definition is, if you have good liquidity in a market, then you can transact large volumes without significantly impacting the price. So these things are important because large volumes, keywords here, impact on the price. Okay. All right. Okay. So this is the understanding of liquidity, that if it's a very deep and liquid market, then you will be able to trade large volumes in that market and it will not have an impact on the price. That's basically what it means. Okay. So with a view on this, what we do is, how did I come up with, because I see that there are 234 stocks in basic materials, I can't give you so many stocks. This is where I use a stock screener. Okay, this stock screener, this is over 50. I hope it's working. I will give you the under 50. Okay, and I hope it will work. Okay, total of 92. Yeah, okay. So what did I do here? I may overshoot by a few minutes, but just bear with me, guys. I will not overshoot too much. Okay. All right. So what do I do? So remember, my consideration is always this: liquidity. I want to be trading only in liquid stocks. I don't want to be trading in some low price stock, not very liquid, which is subject to market manipulation. This is another factor. Market manipulation is less in liquid stocks. Okay. So what do I do? I set up a stock screener. We'll discuss a stock screener later. A stock screener is just basically like a filter. Think of it like a filter. So suddenly I come into the WIPS campus and I see, oh my God, there are like 6,000 students. I can't handle so many people at the same time. Now I say, okay, show me only the male students. Immediately what I've done is, I have cut out almost half the population, so I have made my problem simpler. Now even male students, let's say there are 3,000 male students. I can't handle so many students. Okay, show me all the students who are more than 6 feet tall. Now already I've done a further classification. Some students will go out. Maybe there'll be only 1,000 students left. Now I want to do a further cutoff. I say only out of the students who are more than male students who are more than 6 feet tall, show me only the ones wearing glasses. So you see how by applying filters, I'm continuously cutting down the sample size. Are you able to follow that? Yes, Ketan, Mr. Photographer, are you with us?
Yes, sir, I'm following.
Okay, you are the official photographer. I hope you don't mind if I call you Mr. Photographer. I'm very liberal
No,
with
no, sir.
pulling the legs of students, so I hope nobody gets offended. Okay.
No, sir, it's fine.
Okay. So have you understood, Ketan, how we are using a filter to cut the sample size?
Yes, sir.
Okay, good. So this is all that a stock screener is. What did I do? I went to the stock. So you play with it yourself. Okay, I've given you the link. I think I'll just give you the link here. Okay.
I have a question, sir.
Yes. Okay. I'll just. Who is this?
Sir Siddharth.
Siddharth. Just wait, Siddharth. I'm running out of time. I want to just quickly show this once, and then you can stay back. I'll answer your question. Okay. I'll release the other students. Okay. So what did I do? I can't handle so many stocks. Okay. This 92 has come with after applying my filters. So before, if I did not apply the yellow ones are the filters. So what did I do? I said I want only large cap, which means you remember Rag was mentioning large cap, mid cap. So here they have a definition of, make sure you are clear about your definition. I said show me only 10 billion to 200 billion market cap. Okay, figure out what market cap is. You can read the definitions here. Okay, so that is already a filter. Okay, then I said I want average volume. Any old volume will not do. I want over 2 million. Okay, average volume must be over 2 million. This I think is over 1 month or so, or 3 months or so. Then I want current volume also over 2 million. You see how I'm trying to attack liquidity. Okay, I'm just at the time. I will just release you within a couple of minutes. Okay, you already understood that idea of a filter. I gave you the example of WIP students. I keep applying filters and I keep cutting the sample size. So I applied one filter, second filter, third filter. Country, I only want USA. Okay. Optionable, shortable, we'll discuss later on. These are generally, they all tend to be liquid stocks. Price under $50 because you have only $1 million. Each stock is $100. 100 stocks minimum lot size. Okay. So if you buy any stock, you will have to pay 100 times that price. Okay. Here the price is Avantor is 22.17. If you buy Avantor, market lot is 100 shares, so you'll have to pay 22.17 into 100. So that's why I've chosen prices under $50 so that you can actually trade decent amounts with your $1 million capital available to you. Okay. All right. Now I will release the class because I'm already 1 minute over. But just stay there, guys, before I take the attendance download. Or I think I can still get the attendance download. Maybe you can leave. Okay. So this is what it is. Okay. So if you come back to that point, how did I come at that? Now you see here there are only three basic material stocks. Okay. And one of them has gone out now, but I've given you that stock list. Okay, so this Dow, Freeport, McMoran, it came from there. Okay, Nucor has slipped out. Nucor is a steel company, but you can still keep it. It's a big cap steel company. So this is how I came up with this list. Okay, you can see it, you can do it yourself. I think now you've learned something today. Okay, I'll just take the attendance list. What is all this? You are recording, fine, dismiss it. Windows quiet hours, you won't get notification. Okay, fine. Let me just see. I'll just try to see if I get download attendance list. I'll just download the attendance list, and I have not held you back more than I think you guys can leave now. I downloaded the attendance sheet. Okay, I think you guys can go now. I don't like to hold you back because you have to come back again after 15 minutes for another. Okay, guys, you can go now. And Siddharth, you can stay back and ask your question. I will keep the recording on. Yes, Siddharth.
Yes, sir. My question was that when we're talking about liquidity in the markets,
Yeah.
so sir, does it mean that there will be a less bid-ask spread, and does it mean that the volatility of the prices will also be less
Okay.
of the
Yeah.
stocks?
Yeah, yeah. Okay. So bid ask spread and volatility Okay. Yeah. So answer to your questions, short answer to your question, well, this is definitely low. Okay. In fact, this is almost it's like almost, I'm not trying to make fun of your question, but I'm just showing you how it is tautological by definition almost. That if you are asking, does a person with, is a 80-year-old person who is not wearing glasses, does he have good eyesight? Answer is definitely yes. Okay. In this case, so we define good liquidity by the bid offer spread. If the bid offer spread is low, then that's when we say that the liquidity is very good in this market. All right. So the answer to this question is definitely low bid ask spread if you have high good liquidity. Then high good liquidity as far as volatility is concerned, uh, this is generally, I will not give a categorical answer like the first one. Generally lower, okay, but this is not guaranteed. You can have markets which have very good liquidity, which have high, and also remember that volatility itself keeps on changing for any given market. All right, for any given market will itself keep changing. Okay. All right. Okay. Right. Yes, Siddharth, does it make sense?
Yes, sir.
Yes, let me give
Yes,
you
sir.
one more example. This you understood my point about why volatility itself will keep changing. If you see, this is actually we are anticipating our FDRM project actually. I'm trying to look up this. Yeah, let's look at this. I'll give you one link just to understand that. We'll just take any stock. So there are many ways to measure volatility. Let's look at where we have a historical volatility calculation. Okay, we can look at this. We have this QQQ, right? Let me see here. I was just trying to look at something else where we have, you see if we have HEFGH historical volatility. All right. Okay. We can stop this. Yeah, just historical volatility. You can see this is the measure of volatility for this market, which is QQQ. This is an ETF. This is an ETF which tracks the Nasdaq 100 index. Okay, so you can use it to proxy the Nasdaq 100 index. A very good proxy, almost 100% accurate. So if you see the Nasdaq 100 index ETF, the historical volatility, 10-day historical volatility of the Nasdaq 100 index, to illustrate your point, that understand that volatility itself is we should not talk about it in general terms. We should be very careful about talking about it in general terms, because you can see it's volatility itself is changing. Is this clear, Siddharth?
Yes, sir. Yes,
Okay.
sir.
So those are the two answers to your questions. Anything else? Your answer is
Uh,
you got the answer?
no, sir. I asked this about volatility because uh, we want more volatility because we want to pocket more profits. But then, if there would be high liquidity, but then I got the answer that volatility is different. So I was thinking that
Yeah,
volatility
volatility
remains
itself
very
can
high.
change. Volatility itself can change, and then there are certain things like generally you will find that commodities and equities have the highest volatility. Debt historically has very low, especially government debt has very low volatility. Generally, if you're looking at government debt only, this will have the lowest volatility of all the asset classes. After that, generally will be currencies. After that, generally there'll be a mix of individual equities and commodities. These are very volatile. Okay, but even within a particular class, a particular market, one particular market, which is the market for QQQ ETF, even in that market, volatility itself is a changing factor. So you cannot even talk about it in general terms unless you're very careful, because you have to also make sure that you understand that this itself is changing. Okay.
Yes, sir.
Okay, so if you look at average historical volatility of Nasdaq equity, this is an equity essentially. Okay, this is an ETF, but it's a basket of equities. So if you change this now, if you make this, let's say Amazon, Now we are not talking about a basket of stocks. We're talking about one stock. Okay. Now this one stock has even higher volatility because it's an individual stock. It's not a basket. Okay. Now you see how volatility of Amazon stock, you see that also is changing. It goes from 50 to 10, then goes up again to 50, comes back to 10, goes up to 50. Can you see that? So this itself
Yes.
also is a changing factor, volatility itself. But if you do an average of Amazon volatility, it will be higher than QQQ. It will be higher than currencies. Okay, if you do Euro USD, it will be higher than currencies. You see currency volatility is much lower. Okay, so as a
Yes,
general
yes.
class, but even currency volatility is changing. Even Euro USD is so all volatility for all markets is constantly changing. Right? Is this clear? So answer to
Yes.
your question, I understand your problem. I understand your problem, but the difference is that you can still make money in markets which are very liquid and have low volatility like currencies. Okay, all you're going to do is you're going to be able to trade much. Remember, this is because it's very liquid. You can trade much larger volumes. Okay, where did I go? Liquidity is trade large volumes. So in liquid markets, you can trade very large volumes, and you can still make money by trading larger volumes even though the volatility is lower. This is clear. So
Yes, sir.
the question
So
that is the question that arose in my
I
your
tried
mind,
the currency.
yeah, go ahead.
I tried trading the currency. The bid ask spread was extremely low, and because it was, I think, trading for 24 hours a day. Whenever I opened the TWS, it was trading.
Yeah.
So I guess that's why it's very liquid, the currency market.
Yeah, but okay, guys, one more thing. Please be careful. Don't run down your when you experiment with your TWS. Make sure you don't lose too much money because your then investable capital will run down. You have been given $1 million, so make sure you don't. If you do some trades, you do it mentally and
Yes, sir.
consciously.
I made my trades by the risk
Yeah,
I
yeah,
am taking,
yeah.
so it
If you're
remains liquid.
practicing data order entry and all, do it, but then quickly unwind what you did so that you don't lose too much money.
Okay, sir.
Okay, all right, clear? Okay. So Siddharth, your question is answered?
Yes, sir.
Okay, fine. So we'll dismiss the class now. Anybody has any other question?
Sir, I want to add a few points regarding volatility. I want to know if I am right or wrong.
Yeah.
Sir, isn't the volatility depends upon, like you said, the type of commodity we are investing in. We can even spread the volatility of our own portfolio by mixing the commodities.
Yeah. So in fact, generally that is what you're talking about. Essentially, what you're talking about is the diversification of your. Okay, what you were talking about actually, I think, is reducing the volatility of your.
Yes,
Uh,
sir.
okay.
Overall volatility can be reduced, like diversifying our commodities
Yeah.
and
By mixing, I'll put it this way, by mixing asset classes and markets.
yes, sir.
Right? Okay. So in this case, like when you look at the QQQ, it has, when we showed you the QQQ, it has lower
Yes,
volatility because it's a basket of stocks. Okay. So there
yes,
you're
sir.
reducing the volatility. It is correct. This is basically the argument of diversification. Okay.
Yes, sir.
Okay. Although I would caution you that many people like Warren Buffett, I also don't believe in this diversification business. Many well-known equity investors like Warren Buffett, Jim Rogers, they consider this to be all garbage, this diversification. Okay. So, but you should understand the diversification argument as a beginning finance student. You should understand the argument, and I'm also giving you a second level insight on this topic, that you are absolutely correct that you can reduce the volatility of the portfolio. We are not writing perfect English here. Okay. By mixing asset classes and mixing markets. Okay. Mixing asset classes and mixing markets. Okay. But what is the proviso here? Please understand. What is the assumption here? Provided if all my markets have, remember correlation, regression, correlation, remember?
Yes, sir. Yes, sir. Yes, sir.
So if all my markets are perfectly correlated with one another, will I get any diversification benefit?
No, sir.
No, sir.
So, provided correlation between portfolio component markets. Okay, that means the markets which constitute your portfolio. Remember, each
Yes, sir.
asset is like a market because you are trading it against money, okay, usually. So correlation between portfolio component markets should be less
Yes,
than
sir.
1. Okay, if correlation is 1,
Okay.
then you can add 5,000 stocks in your portfolio, but if they're all one correlated, there is no benefit.
Yes, sir. There will be no benefit.
Yeah. So
Okay.
remember that this is based on the critical assumption that the correlation is less than 1.
Sir, is
Yes.
there a good ratio for this also? Because when I calculated, it came out to be between 0.15 to zero point 0.2 or 3. Point
Which
0.2 or
one?
point 0.3.
Which ratio?
Sir, correlation
Or
between different components.
No. Again, see, the correlation between portfolio component markets also is remember this thing also varies depending on your look back period. Okay. So when you remember when you calculated beta in your FM1 or FM2, whatever.
Yes, sir.
Now,
yes, sir. Yes, sir.
if you did your beta calculation using 1 year of historical data, versus if you did it using 5 years of data, or you use 10 years of data, the results are generally different.
Yes, sir.
Markets are the same, but because you changed your look back period, the data set, essentially you're changing the data set, the size of the data set, and the number is changing. Is that, you remember that?
Yes, sir.
So similarly, correlation between the portfolio component, if you look at correlation between say 5 currencies, okay, you look at correlation matrix between 5 currencies. If you change the component period, if you change the look back period, the correlation numbers will change. All right,
Okay.
is this clear? So
Yes, sir.
correlation also is something where it will change. Okay, volatility also changes. uh, okay, volatility also changes, correlation also changes over time. So when you talk about these things, you have to be very specific. I'm trying to find the Wanda um, FX Labs correlation. There is a very good correlation applet where you can easily see that you can easily see that the correlation, but you already know this because you have seen it from your, and it applies to your beta calculation also. All right, that
Yes, sir.
your anytime you do any kind of correlation analysis, volatility analysis, beta calculation, if you change the look back period, it will change the number. Okay, so you have to be cognizant of this. Okay, this is
Okay.
clear. Yes, Utsav, does it answer your question?
Yes, sir. Yes, sir.
Okay, all right. Okay, guys, so we can, I think you're already late for your next class, or you guys have no class now.
Sir, it
No,
will
sir.
start at 1:30. We have that long break today.
Oh, you have, oh, this is the lunch break. Okay, good. I can
Yes,
Yes,
also
sir.
sir.
go for my lunch break then. Okay, all right, take care then. Okay,
Okay. Thank you
Thank
very
you,
much.
sir.
no other questions. Okay, all right, okay, take care. Okay.